to introduce the moderator who's going to take us through the session, the next session, which is on anti-money laundering, Global South perspectives. And the moderator for this session is Mr. Ebiri. And Ebiri's journey began as an in-house counsel when he was practicing law with top commercial firms in Lagos and in the United States. It was in the later that he obtained his LLM at NYU as an Arthur T. Vanderbilt scholar. Arthur T. Vanderbilt, I think, was the former Chief Justice for New Jersey, at the Supreme Court of New Jersey. Over the years, he built experience with the capital markets and financial teams of Olamiwu Ajayi LP, Templars, and PUNUKA attorneys, all in Lagos, and settled Austin LLP in New York, as well as International Monetary Fund in Washington, D.C. He reminisces about his years in Olamiwu Ajayi LP, that I had role models who believed in my ability and entrusted top-notch and complex assignments to me. This helped me develop legal skills and ability to take up more tasks and deliver, he said. Ebiri has been a principal legal counsel with AFDB headquarters in Abidjan, Côte d'Ivoire since October 2018. In his capacity, he advises and supports the bank treasury on borrowing in international and local capital money markets, as well as negotiation and documentation of derivatives and other risk management transactions. He also supports the AFDB Resource Mobilization and Partnerships Department in establishing trust funds, special funds, and other resource mobilization efforts. So I will hand over to Mr. Ebiri.
Thank you very much, Lucky Star, for that very kind introduction. Without any much further ado, I would just like us to go into this next session that is captioned Anti-Money Laundering, Global South Perspective. And I'm just going to generally introduce all the very formidable speakers we have gathered for this very session. And since you already have the citation of each one of them, I'll just go straight to call them so that I don't stand on the way of you listening to these very fantastic speakers. So firstly, we have Professor Abdullahi Shehu, who is a Nigerian ambassador designate to the Russian Federation. And after him, we'll have Dr. Constance V.W. Gikonyo, who is of the University of Nairobi. And then thereafter, we'll have Dr. Nkechukwu Azinge, who is of the University of Lincoln. And then thereafter, we have Ms. Sorry if I pronounce your name in a way that you wouldn't want it to be pronounced. I'm just trying to be as proper as possible in the pronunciation of the names. After that will be Ms. Cheludo Timaye Butale of the Cyprus International University. And then thereafter, we'll hear from Dr. Chijioke Ofoji of the Liverpool John Moores University. So at this point, I'm going to turn it over to Professor Abdullahi Shehu, who is Nigerian ambassador designate to the Russian Federation. And he's going to be speaking to us on the topic, resolving the paradox of customer due diligence, a global South perspective. Over to you, Professor Shehu. Thank you.
Thank you so much, ladies and gentlemen. Let me begin by thanking Nkechi and Folashade really for your tenacity and commitment to this project. And I'm glad to see you people very active on this project and where you have reached thus far. I am here to lend my support to this project and also my association with the Global South Dialogue on Economic Crime. Now, you asked me to talk about resolving the paradox of customer due diligence. Therefore, I have an outline. The next slide. Okay, I'd like to begin by some imaginary statistics that I have drawn from the World Bank in 2018, where it is estimated that about 1 billion people around the world face challenges in proving who they are, and about 1 billion people are believed to live without an official proof of identity. 81% of this figure live in sub-Saharan Africa and South Asia. 47% are below the national ID age of their own country or their countries. 63% live in lower middle income economies, while 28% live in lower income economies. Now, what does this suggest? This suggests the challenges associated with customer due diligence as a model for the prevention and control of money laundering globally. Next slide. In response to the challenges of money laundering, the FATF was established in 1989, and it develops a set of 40 recommendations, which is commonly referred to as the acceptable international standards against money laundering. And about 60% of these standards consist of standards that have to do with customer due diligence. Customer due diligence is based on effective anti-money laundering risk-based approach. In other words, reporting entities to know their customers, KYC, which is the bedrock of the specific recommendations of the FATF for the prevention of money laundering contained in recommendations 9 to 23. Specifically, recommendation 10, which is meant for financial institutions, and recommendation 22, meant for designated non-financial professions and businesses. These are the component blocks for enforcing due diligence, particularly knowing your customer within the framework of the FATF standard. CDD requirements generally include prohibition of anonymous accounts or accounts in fictitious names. And this applies to financial institutions, and therefore, financial institutions are required under CDD to identify and verify the identity of their customers using reliable, dependable, and verifiable documents, data, or information. I'm being very precise, but I would like to draw your attention to the adjectives that have been used in the FATF standard. The words that are used are very carefully selected. Financial institutions or reporting entities are also required to identify the beneficial owner of each and every transaction. They are to understand and maintain or obtain information on the purpose and nature of each business relationship with their customers. And most importantly, they are to conduct ongoing due diligence. In other words, to scrutinize every customer they deal with, to know the customer very well so that they are sure that their transactions are devoid of money laundering. Next slide. To do this, the FATF has developed several guidance notes in order to assist countries across the world to enforce CDD measures. In 2013, the FATF developed the guidance on AML CFT and financial inclusion. Financial inclusion is actually one of the best approaches to resolve the paradox of CDD. It also developed the guidance on risk-based approach, which is basically based on the risk perception, not necessarily the customer's perception, but the risk perception or the perception of risk in every jurisdiction. It also developed a paper on low capacity countries to enable them address significant and strategic issues that confront them with respect to enforcing effective customer due diligence measures in their respective institutions. The Basel guidance, which was issued in 2014, complements the FATF standards and guidance with respect to this. Overall, the global mutual evaluation reports serve as parameters for reviewing and updating compliance with the FATF standards with respect to due diligence and other compliance issues, generally in the prevention and control of money laundering, terrorist financing, and the financing of weapons of mass destruction. Next. Graphically, in the African situation, for example, I believe when Nkechi is going to talk, she's going to highlight the challenges encountered with respect to enforcing CDD in Africa. And this is graphically what I use to demonstrate what goes on with respect to enforcing CDD. First of all, the money laundering and terrorist financing risk must be understood through a national risk assessment. Secondly, there must be consistent STR and CTR reporting by reporting entities, not only financial institutions. And then there should be significant records keeping. Now, when these are achieved, there must be effective investigation as well as good FIU analysis in order to turn the STRs into qualitative intelligence for action. Where that is done, the financial institutions, particularly the regulators, will enforce that by effective AML safety inspection. This will now support the outcome of investigation in the form of confiscation of proceeds of crime, and that will provide a robust AML safety regime in any system. So this is simply the cycle that I tried to characterize in this presentation. Next slide, please. For us to be able to understand and how to resolve the paradox of CDD, we must first of all understand the factors that inhibit CDD in the first place. And these are many. The first broad category has to do with the legal gaps. If there is no sufficient laws, or if the laws do not provide clarity for entities to comply, there will certainly be a problem with CDD. Secondly, when there is regulatory gaps, including lack of capacity of the regulatory authorities, for example, to ensure regular inspection and supervision of reporting institutions. Thirdly, poor infrastructure to support all efforts. For example, the absence of a national central identification database, or the reliability of the database or the identities themselves. Now, other challenges that affect the effective enforcement of CDD include the unreliability of the means of identification, particularly in many African countries, where you find that they have not actually established the national identities, and where the national identity cards are provided, some are either forged or stolen. Poor street naming and numbering also affects customer due diligence, especially where financial institutions are required to verify the identity of their customers by visiting the given address of their clients. So in Africa, this is a major challenge. Another challenge has to do with cultural issues. They believe that people say, well, we don't want people to know that we have money, so we prefer to keep it in the house. So this leads to a lot of cash being in circulation. Again, the issue of competition among banks will make them to compromise certain CDD measures, as well as insider dealings and tip-off. Well, this is not only common to Africa, this is a general problem. So what I'm trying to say in a nutshell is that while some of these challenges are peculiar to Africa, a good number of them also apply to other developed economies. And this is the reason why it is important to ensure that there is global coordination in implementing the appropriate standards. Next slide. Now, my final point is I try to attempt to make some prognosis on how to resolve the paradox. And I look at it from two responsibilities. At the national authorities level, countries must establish, strengthen, and harmonize the identification system. Secondly, they need to improve their streets numbering. And thirdly, they need to promote financial inclusion. This is where there are a number of issues. Financial inclusion will require a reduction in cash transactions or placing a limit in cash transactions. It will also require the establishment of microfinance in order to bring financial services closer to people who are considered unbankable. It may also require provision of innovative money laundering services, including different money laundering, cryptocurrency, et cetera, that were discussed during the previous session. So in my view, these responsibilities can only be achieved at the national level when there is a comprehensive legislation in place and there is a political will to really ensure that the legislation is enforced. Next. Now, from the part of reporting entities, they also have certain responsibilities. One, they have to ensure the collection of appropriate CDD information from the first point of contact with their clients. They need to know what sort of information they must obtain from their clients and how they can manage such information according to law. Secondly, they need to deploy effective AML CFT solution software, which is very common now, and technology has already helped in the prevention and control money laundering. Thirdly, they should establish policy and processes to identify beneficial ownership in every transaction. Four, they may use alternative means of identification where it is difficult for some people, unbankable customers, to have means of identification. You may rely on their voters' registration cards or biometric verification system, or even you rely on traditional rulers, typical African where most people are, or some people are illiterate. So this may be very helpful. Number five, it is important that there is continuous training for financial institutions, especially those that are involved in anti-money laundering supervision and enforcement. Six, all institutions or reporting entities must be made to develop a robust database for monitoring of politically exposed persons. Seven, they must introduce low-risk banking with respect to financial products and services. It should make some of the products less attractive for money laundering purposes. And most importantly, they must enforce a risk-based approach for CDD to be effective. Next. In conclusion, I would like to state in a nutshell that it is not only about compliance, it's about effective coordination. When there are effective systems in other parts of the world, and any part of the world is not effectively regulated, then the weak link would create the opportunity and vulnerabilities for money laundering. However, with respect to the enforcement of the FATF standards, which are expected to be rolled out all over the world, regardless of the state of development of our countries. There is no one fits all solution. So what is it in it for me should be the approach that everybody has a stake in what we are doing for everybody to contribute. Now, when I look at the screen here, I look at Folashade's picture smiling at me. I am beginning to ask myself whether I am in a technological world or I am in a physical world. I did not say you should remove it, Shadi. Now, the picture that was smiling there is exactly the Shadi that I can see. But that picture is showing me as if I'm in a new technological world or where I am. Anyway, that is just to close on a very lighter mood. I would like to thank you very much for giving me the opportunity to contribute to your program, and I wish you all the best. Thank you very much.
Thank you very much, Professor Shehu, for that very insightful presentation. And, thank you so much for being able to talk to us about the paradoxical issues that are raised by the customer due diligence issues that we regard to the FATF standards or principles, as the case may be, recommendations. And thank you again for letting us know, because as you rightly pointed out, if all the countries are not working hand in hand, there will be an issue in terms of achieving a global resolution of the paradoxes, because you said we are only as strong as our weakest link. And with that said, I'm going to go to the next presenter on the panel. That would be Dr. Constance V.W. Jinkoyo of the University of Nairobi. Dr. Jinkoyo will be talking to us on the topic uncovering conflicts and ambiguities in the international anti-money laundering regime vis-a-vis African country. I just wanted to let the audience know that, as Dr. Malala pointed out at the beginning, you have the Slido where you can send in your questions, so that at the end of the session, we'll be able to address questions. And please, when you are sending your question, please do well to signpost it to a particular panelist so that it will be addressed accordingly. Thank you. Dr. Jinkoyo.
Thank you, Edri, for welcoming us for this session. And thank you to the organizers for the opportunity to be here today. So far, I have learned a lot myself. And I hope that what I will share will equally be of interest. So as the last presenter has said, a one-size-fits-all does not work. I have had the interest of looking at the anti-money laundering regime in my country, which prompted me to get interested whether some of the challenges I was seeing being faced in Kenya are the same in other African countries. And as I read more and more, I realized there were certain similarities that the African countries, and as other global South countries or other developing countries were facing in terms of implementing the international anti-money laundering regime. So that is what I want to focus on today. What are the issues? Next slide, please. What are these issues? What are the biases, the contradictions, the assumptions that were made when coming up with this anti-money laundering regime and asking the African countries to implement it? Because the question so far has been that Africa has tried, but predominantly that it's not effective. And so that it has been argued that the Africans really just don't want to implement it. But when you interrogate the international anti-money laundering regime, you realize that there are other underlying aspects or issues that have actually led to the existing state of affairs. So then the question is, can we reverse it? And to be able to do so, we need to look at these underlying issues that need to be addressed. So I have, next slide, please. I have categorized these in 5 subcategories: the developmental or historical issues, the institutional issues, cultural issues, economic issues, and implementation issues. So we will begin by looking at the developmental or historical issues. Next slide, please. This takes us to these key questions that we need to ask us. Who were the agents of the anti-money laundering policy transfer? What exactly was transferred, from where, and why? When did the transfer occur? Why did the African countries adopt the anti-money laundering policies in the manner that they did? And also, how did that transfer take place? Now, in answer to the first question, who are the agents? The agents, actually, if you read historically, you will realize that the country that pushed the most for the anti-money laundering policy to be adopted was the US. Much of it is said to, the story about anti-money laundering policy usually begins with the FATF, where you had the G7 meeting that led to its formation. But go behind the G7 meeting, it was actually America. Why did America seek to have these anti-money laundering policies, which they already had in their country? They realized that for them to work, they needed a global perspective. And so we need a global forum to push for that. And you discover there were even tensions then with the formation with countries like France. But eventually, FATF was formed. Now, what exactly was transferred again? If you look again carefully, you will realize that much of what was being transferred then was actually policies that America had in place. Now, when did the transfer occur? The transfer occurred when the war, the formation of the FATF happened when the war on drugs in America and organized crime was at its peak. What about for us in Africa, when we were being made to adopt the AML policy? Most African countries either were still within undergoing the structural adjustment programs implemented by the IMF, the World Bank, or they were now exiting. And we all know the history of what happened with most of those policies. So most African countries actually had no choice. They were cornered that we have to adopt. And that's why the last question, how did the transfer take place? Was it coercive or voluntary? It was actually not voluntary. It was coercive. And in addition to that, comes in the aspect of mimicry, because the African countries felt we don't want to be left out. So we must mimic. We must do what country X has done so that we are in the right light. The other aspect linked to mimicry is the fact that competition effects. And this is tied into the aspect of coercion. That if you do not, and if you read the history of a country like Nauru, Nauru really suffered when they purported to say they would not adopt the AML policies. They were actually, their banking industry suffered, almost collapsing. So when other countries, African countries realize this, you realize you have no option. We must adopt it. So the transfer was not done voluntarily, but coercively. Now, all this together comes what the last speaker has presented, the issue of a one-size-fits-all. We were given these policies and told, here you go, implement. There was no evaluation of the current system within the African countries to see whether this AML policy transfer would fit in well with what was happening economically, socially, financially within the African countries. It was these are the policies, make them work. So we as the Global South were not involved in developing these initiatives. Ours was just to adopt them. Now, this has actually led to some people saying that the adoption of the AML policies was some form of neo-colonialism. And as I said, if you look at this aspect in light of the fact that most African countries had just come from this dealing with this issue of structural adjustment programs, really, you would understand why this interpretation that adoption of the AML policies was a form of neo-colonialism. So we were implementing something that we really did not believe in, but because to be competitive at the global market, because if we do not, our financial systems will be shunned, could even lead to collapse. We will be uncompetitive globally. We had to do it. So this being the historical manner in which we adopted the AML policies, some of these issues have continued to tag at the implementation of the AML policies in African countries. Next slide, please. Now, tied together with these developmental issues are the institutional ones. The fragmentation of systems in Africa, and the previous presenter has highlighted that a lot when it comes to, for example, undertaking customer due diligence. We don't have central registries, for example, so that it becomes very difficult to conduct due diligence on customers. In some countries, even a central registry for corporate bodies like companies do not exist. So even establishing things like the ultimate beneficial owner of a company becomes difficult. Kenya is only now in the process of establishing the ultimate beneficial owner registry. Looking even at our own land registration systems, most of the African countries, there's a problem. By the time, because land is even communally owned, then you have the delays in our judicial system, which lead to inefficiencies in administering punishment. And then this is coupled with the aspect of lack of political will, that at times those who are politically connected never really get punished. A case will be lodged in court, but somewhere, after a lot of hullabaloo, quietly, nothing happens, and we never hear again of the matter. Yet to properly implement the AML system and send the proper message, a properly functioning judicial system is very relevant. If even, for example, you are going to undertake prosecution for money laundering and eventually undertake asset forfeiture, a properly functioning judicial system is relevant. The other aspect under institutional problems is the fact that the AML strategy focuses on private sector more for implementation, which therefore leads to the other problem. The public-private boundaries of governance have been crossed. So the private entities are feeling, look, this is not our role. Why are we as banks being required to undertake customer due diligence? That's not our work. Some of these things should be done by the government. Why should we tell on our clients? And the banks will ask that. For us, we are here to make money. We want people to deposit money with us. They transact this money. That's how we make a profit. But now that we are being told we must tell on our client if they deposit this amount of money, if they withdraw this amount of money, why should we? So that focus, and therefore, which means, by the way, that the cost to the private sector for implementation is really high. And it's only now that a dialogue between the two entities, public and private, is beginning in certain instances. It has been a case of government saying, private, you must do this, period. No discussion of how can we go about this? Can we actually implement this? Can we talk? Can we modify this so that we are able to do it? Such conversations have actually not been held. Next slide, please. Then comes the cultural perspectives or cultural issues. And this, even in most literature, have actually been overlooked. But my view is that these are also very key in explaining the lackluster implementation of AML policies in Africa. When we talk about the lack of political will, it is tied to some certain cultural perspectives. Now, culture is not just about song and dance, the songs that we sing, the language that we speak. Culture encompasses very many things. How we as a people behave, how we think, how we view certain things. And that culture is passed on from one generation to the next. It is as a result of socialization. So that as a child, you will look at what your parents are doing and you emulate that. Your children look at what you're doing and continue to emulate that. So what are these cultural perspectives that tie with how AML is implemented in Africa? Now, first, much of the African society, we are moving from communal ownership of various, be it land, be it wealth, in whatever form. You know, even taking care of children was a communal aspect. It's only now, you know, you cannot go and beat anyone's child if you find them doing something wrong. But before, it was very easy. I find you doing wrong, I'm like your mother, I beat you up, and I move on. The concept of communal ownership or togetherness. But we are now moving to individualism. And this has come with the aspect of accumulation of wealth. And that we view, that being the case, we view that the more wealth I have, the more society looks at me and says, I have made it. And we respect them highly in society. You know, we will be telling our children, you need to be like so and so, they have made it. Are you seeing the houses this person owns, the vehicles they drive? And this now, like for example in Kenya, drives people to do very absurd things or even illegal things to make that money. Which again now comes to the next point, the cultural perception, our orientation. What are our cultural morals and attitudes on various things? So that we really don't care. It's get rich quick. However you get your money, we don't want to know. Just get rich quick. Or if you happen to be in power, it's your turn to eat. And once you leave power, it is okay. The next people coming in, it is their turn to eat.
Dr. Jikoyi, you have 3 minutes to wrap up, please.
Okay, yes, please. And that comes in with the aspect of cultural impunity. So instead of looking and saying that this is wrong, this is not right, we look at it as something good. The misconception in Africa that wealth equates to political and social power. For anyone to vie for a political seat, we look at how much wealth you have in most African countries. Then lastly, do we have even a culture of compliance in Africa? Generally, we tend not to. For us to be able to achieve all what we have talked about before, to be seen to be rich, compliance is not for us. Next slide, please. Then comes the economic aspects, which have been touched on by a number of the presenters today. What does the model for AML suit the socio-economic needs of Africa? We are a cash-based society. Our reliance on alternative means of value transfer, such as Hawala. The levels of development in society are low, so that you don't even have that many banked people. Yet the AML focuses so much on the banked members of society. What Madame Buku spoke about, we rely on other means of money transfer more than even the banks. Next slide, please. Then comes the issues of compliance that I have already hinted upon. The cost of compliance is high. So most that dissuades entities from engaging or attempting to begin compliance. Then the gaps in implementation. Certain businesses have been excluded. Cash-intensive businesses, very many of them have been excluded, which are relevant or would be relevant in the African context. Then the financial and other designated non-financial businesses and professions are expected to design their own preventative measures instead of a joint collaboration that pulls together the resources that are available, so that that lessens the burden and encourages implementation of the AML policies. Then we need to also ask ourselves, do our regional bodies like the African Union have the capacity to assist us or to assist countries in implementation of these AML policies? Because certain countries have bigger problems at the moment to worry about, e.g. feeding their people and sheltering them, more than AML policies. Next slide, please.
Dr. Jinkoyo, I hope that will be your concluding slide, because you're out of time, but please, can you conclude in 1 minute?
Yes, please. Yes, please. Then we have the aspect of we rely on outsiders to come and tell us our problems and tell us how to implement. Yet, instead of looking at our locals, people who understand the peculiarities of a particular country, so that we get what is best for us. Next slide, please. And I believe it is the last one. So what are the solutions? Include Africa in the agenda setting. Don't exclude us. Do not, the one-size-fits-all approach is not working. Can African countries need each on their own to undertake their own risk assessment? There's also need to undertake a regulatory impact assessment so that you assess the cost and the benefit. Joint efforts, pulling together, so that the little resources we have, we see what we can do. Review the financial reporting mechanisms and see, so that we implement what works for us. Last slide, please. Develop systems that we can implement with the capacities that we have, right? And then look to each other as similar countries for policy transfer, so that we are looking at countries that are experiencing similar challenges to us. And most importantly, self-reflection and examination as a country. Look where the policy came from, what informed it, etc., before we implement. And therefore, work at adaptation, not just adopting, but adaptation. And lastly, we need political will to be able to implement. Thank you very much.
Thank you very much, Dr. Jinkoyo. That was a mouthful, and I am very much confident that the audience have taken copious notes of your very, very insightful presentation. And without much further ado, I'm going to invite our next speaker, Dr. Nkechi Azinge of the University of Lincoln. She will be speaking to us on the topic AML, CFT, compliance challenges in African countries. Dr. Azinge, you have 10 minutes. Thank you.
Thank you. Good day, everyone. It's a pleasure to address you all this evening. So today I'll be speaking on the anti-money laundering compliance challenges in African countries. And my presentation takes the view that understanding Africa's compliance actually requires a connection of the dots, which according to Steve Jobs, as we've all heard, arguably is best done looking backwards. Now, so I would adopt a contextual approach in framing my presentation. Give me a second, I'll just put this in presentation view. Okay. So I'll adopt a contextual approach in framing my presentation. My core argument is that there's actually a correlation between Africa's colonial history and its money laundering occurrences and regulation thereof. Yet the global standards adopted to combat these crimes and the benchmarking framework as well do not consider the continent's peculiarities. And this is actually a problem, which is a catalyst for paradoxical implications and also unintended consequences, as the two earlier speakers have emphasized. So my arguments are presented in three parts. First, I'll discuss Africa's colonial history and its impact on money laundering regulation thereof. Secondly, I'll highlight the compliance trajectory of African countries. And lastly, I would examine the compliance challenges of African countries in brief, given the elaborate conversation by Dr. Constance. So as mentioned, I'll start by discussing the colonial history of African countries and its money laundering implications. Now, when we have conversations about colonialism, you would see that there is that eagerness to focus on slave trade, but there's minimal focus on how natural resources of African countries were brazenly stolen and extorted. Walter Rodney captured this aptly in his book, How Europe Underdeveloped Africa, where he stated that colonial masters sought to repatriate the profits from exploitative activities on Africa's natural resources to the so-called motherland. Now, colonial masters employed a series of tactics to achieve their aims, including illicit transfers, exorbitant taxation, the granting of exclusive rights over mineral and natural resources to British firms. And the interesting part of all of this is that these strategies were actually legalized. Now, the prevalent exploitation by colonial masters actually set the tone for the decolonization struggle. So while African countries were pushing for independence, a number of African countries were pushing for independence, they faced pushback from their colonial masters, who argued that the people at the forefront of the independence fight were actually corrupt, right? And they had cases of corruption, money laundering, and bribery hanging on their neck. And for this reason, they were very ill prepared to take on independence. But subsequent reports revealed that the colonial masters had actually expected their colonies to behave this way, and they did. So, for instance, when countries gained independence, what we noticed is that political appointments were given to a lot of the freedom fighters. And these powers allowed them to issue licenses, to award contracts, to award scholarships. But the interesting part of this is that they exploited these avenues to gain kickbacks. And across African countries, or in many African countries, we saw the military regime coming in, taking power. In Nigeria, we saw about 6 military coups, and what they were all fighting against was corruption. But again, we saw in Nigeria, we saw that General Abacha was one of those who engaged largely in money laundering, which is beyond corruption. So whilst the fight was against corruption, there was very minimal focus on money laundering. As Dr. Ginkoyo had mentioned, what we would see is that Africa's focus on money laundering was actually really belated. And that belated focus was actually engineered through a neo-colonialist agenda, which was actually spearheaded by the G7. So the group of 7 countries, primarily the US, the UK, and France, came together, established the G7, and they already had existing frameworks within their banking system, existing frameworks to combat money laundering. And they used these frameworks to set 40 recommendations on money laundering and terrorist financing, which were then applicable globally. Now, there are 2 important things to note, and I'll be repeating myself in this. First is that the source of the recommendations were derived from extant banking standards in the G7 countries. So arguably, what we'll then see is that if these countries are developing these standards are more suited to their terrain. And secondly, what we'll then notice is that when you look at the membership of the FATF, you would see that the membership of the FATF is actually critical in shaping and reshaping its standards. Currently, we have 37 member countries. South Africa is the only African country that is currently a member of the FATF. Now, the absence of an institutional voice, as Professor Shehu had mentioned, we will then see that it's actually not unsurprising that the resultant framework actually lacks the nuances that would actually facilitate Africa's robust compliance. Then it begs the question, how does the absence of a voice, alongside the many issues that resulted from colonialism, actually reflect in Africa's compliance? So this brings us to look at Africa's compliance trajectory. Now, and this is the second part of my presentation. So with the FATF, what they do is that with countries, They go into countries, they conduct mutual evaluation, practically trying to rank how compliant each country is to the 40 recommendations. Now, once they rank these countries, for every recommendation, you know your compliance level to that recommendation. And then there are follow-up reports that happen every subsequent period, right? Now, so what I did is I examined the compliance trajectory of 38 African countries from 2007 to 2015 to see how they were complying, right? And with these 38 African countries, what I found was that only 8 countries were able to record over 50% compliance. And guess what? South Africa, that is even a member of the FATF, was not the most compliant country. Egypt was actually the most compliant country, but still falling short of the 65% benchmark, right? So we see Egypt, Tunisia, Mauritius, and also South Africa doing quite well, but I would say that their compliance level is still apathetically low, and it is not unsurprising. And what we'll then see is that at least 30% of these countries recorded less than 50% compliance level. So how best can the colonial history, coupled with the lack of a nuanced approach, explain this? Give me a second. So this would practically reiterate a lot of the points that Dr. Ginkoyo made, but then I'll keep it brief. Well, I'll start by saying that Africa's colonial history has crippled its development across various facets, right? And one key area, it is ability to have the necessary preconditions to actually necessary preconditions for effective regulation of money laundering, right? So we do not have what it takes to actually combat these crimes. And this can also be tied to the residues of colonialism. And there are two critical preconditions I noted. One is law, and the second is confidence. Now, when I say confidence, confidence is more than the word confidence. Confidence in this case is synonymous to trust. And confidence in this case, basically, when we say that we trust the country, what you're then saying is that the trust you have in that country, or the trust that people have in that country, actually determines the extent of investment or engagement in that country's economy or financial system. But what we then see in African countries is that there's a crisis of confidence in Africa's political and governance system, and also in its regulatory and enforcement frameworks, even the judicial framework, as Dr. Kinkoyo mentioned. So what this does is that it not only undermines Africa's compliance, but it also hinders foreign direct investment. And the second I mentioned earlier is law, right? So the law matters thesis would tell us that law is actually critical in combating financial crime, right? However, we see a perplexing picture in African countries as they engage in copy and paste, right? So in trying to transplant laws or transplant the FATF standards, it's let's copy this, let's paste this, right? Now, this is not the case with all the laws, but this is the case with some of the laws, right? Now, unsurprisingly, a few months ago, I was speaking with a staffer of an international financial institution, and he mentioned that the laws in African countries are quite good. We see really good laws, and there are only minimal issues with the laws. Now, these so-called minimal issues actually have paradoxical implications. And in some instances, transplantation is done in error, right? So let's take, for instance, Nigeria's attempt at regulating lawyers for money laundering. Now, the FATF designates lawyers as non-financial business professionals, meaning that they are gatekeepers. And the expectation is that lawyers would ensure that their clients do not use their services, so the lawyer's services, to launder money, right? Now, countries are expected to domesticate this standard with the requirement that lawyers engage in customer due diligence. So basically know your customer, know your client, and ensure that you understand your client's business, right? And more importantly, lawyers are also to report suspicious transactions, emphasis on suspicious. Now, when you look at Nigeria's law, now that part of the law has now been expunged. Now, the legislation actually revealed that the law mandated lawyers to submit every client transaction with a significantly low threshold of £1,000 without any suspicion. Now, that in itself was done erroneously, and it is problematic. Now, this in itself actually circumvents the spirit of the FATF recommendation and undermines legal professional privileges. Additionally, it demonstrates that transplanted frameworks do not necessarily make the journey and may be done in error due to disparity in understanding and perception. Now, irrespective of the erroneous transplantation and also the paradoxical implications, African countries are still listed by the Financial Action Task Force when they fall short of compliance. Now, the FATF blacklist, which now is called the list or grey list, was and still remains its enforcement mechanism, which is aimed at publicly naming and shaming non-compliant countries with the aim of securing compliance to its standards, right? And it has implications. Once you are listed by the FATF, developmental lenders become very wary of dealing with you. Correspondent banking relationships are kind of skewed, or to an extent, banks in your countries may be de-risked, right? Foreign investments become limited. The cost of remittances, which a lot of African countries depend heavily on, becomes even more expensive. So Nigeria was the first West African countries to be listed, and currently we have 4 African countries on the list, including Ghana, which is quite surprising, because when you speak with a lot of people, the implication, the story you hear is that Ghana is doing quite well, but Ghana is still listed. Now, there are arguments that blacklisting in itself is a catalyst for improved compliance, right? Now, Julia Morse argued this strongly in a recent Oxford University publication, basically saying when you blacklist countries, they are more geared to comply, largely because of the reputational clause and also reputational cost and the monetary cost. Now, the question is that, or the issue with this is that it does not necessarily consider the dichotomy between formal and proactive compliance, right? As whilst countries may actually comply on paper, their willingness and ability to comply is actually limited, right? Professor Mascriando refers to this as the stigma paradox. So where countries would strategically elude regulation, right? So in paper, it does seem like they're complying, but in reality, if you live in Nigeria, if you follow the Nigerian news, if you know what's going on, you would know that Nigeria maybe should be listed at this point, but it's not. So the question then becomes—
Dr. Zinge, you have 2 minutes.
Okay, thank you. The question then becomes, what is the way forward, right? So on one hand, African countries may push for a stronger voice to influence global standards, and therefore these global standards will start to recognize their local realities. Now, this seems very ideal and far-fetched, but in reality, it's not, right? The FATF in itself is currently examining the unintended consequences of erroneous application of its standards, and this is actually a pathway forward for African countries. Now, again, the results are still unknown, but we hope that in the near future, we will see the outcome of this, and hopefully this might be a step forward for African countries. Alternatively, or rather alongside African countries, alongside seeking a voice, African countries ought to work towards improving their preconditions for effective regulation, notwithstanding their colonial history or antecedents. Yes, we understand and we recognize that correlation, but at some point there has to be a moving forward. These approaches would no doubt cascade an alignment of the global standards with local realities. Thank you.
Okay. Thank you very much, Dr. Azinge, for the insightful presentation. And I wouldn't want to try to summarize her presentation, so we'll just go straight into the next session, which our next speaker is Ms. Cheludo Tinanye Butale of Cyprus International University. She'll be speaking to us on the topic, Global AML Standards, Implications for Women NGOs. Ms. Butale, over to you.
Good afternoon, everyone. Thank you for the lovely introduction. I'd just like to I thank the organizers for having organized such an amazing event. So my focus will be on the global anti-money laundering standards and the implications for women and governmental organizations. So let me just share my screen. So can you hear me?
Yes, we can hear you.
Okay, okay. Okay. So my presentation outline will be as follows. I'll just briefly highlight the global AML, anti-money laundering standards, then focus on the AFTA, FATF, and then give a definition of NPOs and the challenges of the interpretations of FATF's recommendations and the lawmaking process challenges, and highlight just the global non-profit organization coalition, what it does and how it's connected to the AFTA. And then I'll give the impact on women non-governmental organizations and just a few case studies and a conclusion. To start, the FATF has played a major role in setting up the global framework of norms designed to counter terrorism, financing, and money laundering. It extends and complements the UNSCR resolution or United Nations Security Council resolutions 1267, 1373, and other resolutions. Basically, these resolutions are like the Palermo Conventions, Vienna Conventions that deal with transnational organized crimes or drug trafficking issues. So the FATF complements it in terms of issues of terrorist financing through its recommendation. So FATF is an international organization, as was mentioned by the earlier speakers, established in 1989 to enhance cooperation among states in combating money laundering and terrorism financing. And its 40 recommendations constitute the basic legal framework for preventing, detecting, and suppressing money laundering and terrorist financing. So I've just highlighted how the FATF complements the UN standards in terms of the Palermo, the Vienna Convention, so I won't dwell too much on that. I'll move straight to the FATF and what exactly it does, its background briefly. So it consists of 36 members, 8 FATF style-like regional bodies and 25 observer organizations, and its standards are applied in 180 jurisdictions. It also has mutual evaluations or assessments that rate countries' level of compliance according to largely compliant, not compliant, etc. And it regulates issues of great interest to the market for investor confidence. But then again, the challenge with FATF, unlike other intergovernmental organizations, it's not regulated by an international treaty. And by it not being regulated by an international treaty, it's the way it's prone or can be prone to public scrutiny is limited due to that perspective. So within the FATF documents, the definitions of nonprofit organization is as follows: a legal person or arrangement or organization that primarily engages in raising or disbursing funds for purposes such as charitable, religious, cultural, educational, social purposes, and carrying out other types of good works. And within that definition of the NPOs, the nonprofit organization, is recommendation 8, which is intended to apply only to those NPOs that pose the greatest threat to terrorism financing. Not all NPOs are high risk, but unfortunately within the FATF's document, it does not really distinguish between potential risk and actual abuse by terrorists. And as a result of this ambiguity, it may result in challenges in adopting a risk-based approach or proportional approach methods in terms of dealing with issues of NPOs and their association with terrorism financing. And then the types of NPOs that FATF highlights is the service role NPOs, those that provide services such as health and education and social services and development and housing. And the expressive roles are those that undertake activities such as cultural recreation activities. So most of the NPOs that are regarded as a risk to terrorist, a risk of abuse for terrorist financing is the service role NPOs, since they are regarded to be the ones that work within close proximity to active terrorist threats. But then again, we raise the question that by them working in close proximity within active terrorist threats, is it enough for us to then say that they are a threat? They could be aiding or helping with terrorist financing, because there are some NGOs that help victims that are targeted by terrorists, that are there to also help people there. So this is also part of the ambiguity and the unclear statements that is mentioned within the FATF's document on NPOs. And then zoning in or coming to the FATF's 40 recommendation, particularly that deals with the NPOs, which NPOs are also non-governmental organizations. So it's the recommendation 8 is supposed to address the particular vulnerability of NPOs to terrorism financing and abuse. Unfortunately, it has had numerous unintended consequences. By it, we have seen that there's been increased state surveillance and regulation of the sector without any targeted or risk-based approach. There have been cases of over-regulation. NPOs face difficulties or go through cumbersome registering and licensing laws and increased regulations of the sector. And we have seen banks closing accounts, delays in accounts, refusing to transfer funds for NPOs as a result of this recommendation 8, unintended consequences. Because of the unintended consequences of this recommendation 8, the Global Non-Profit Organization Coalition, which is engaged with FATF most of the time, then was engaged by FATF to revise the recommendation 8. So by revising the recommendation 8, they focus on proportionate measures in line with the risk approach to non-profit organization to protect NPOs from terrorist financing abuse. So they focus on this, that depending on the risk, whether the risk is high or low, that proportional measure or risk-based approach should be used to assess the perspective of the NGOs. Unlike the previous recommendation 8, it just then generalized all NGOs as being vulnerable to terrorist funding or terrorism funding. But this new one is saying focus on proportionate measures. However, within this statement that is saying focus on proportionate members, we then ask ourselves that recommendation 8, does it really provide details for this risk-based approach in terms of how countries should undertake this risk-based approach and how they should involve the NPOs? As a result of this unclear wording or terms, it may be a challenge for governments to make their own assessments and determine which NPOs are at high risk of financial abuse because of the statement of the revised recommendation 8. The other challenge is the broad definition of the word terrorism financing. Terrorism financing, normally within it's defined as raising funds, transfer of funds for logistical support for terrorist groups. But how do we then zone it down to the actual terrorist financing of NGOs? That is also the challenge in terms of the wording. And then the risk-based approach that was adopted in line still with a nonprofit organization the risk-based tool was adopted in terms of to try and see where threats can exploit vulnerabilities. So the way it is used, or the way it's supposed to be used by countries, is countries have to familiarize themselves with this definition of NPOs by FATF, and then from there recognize the vulnerabilities of those NPOs, those that may be vulnerable to threat of terrorist funding. And then from there, countries should have the relevant measures in place and adopt a risk-based approach to those sectors that they feel are at high risk. So the challenge with this—
Ms. Butale, can you summarize in 2 minutes?
Okay, yes, okay. The challenge there's been a challenge in implementing or understanding the risk-based approach by various countries. Then the challenge again was lack of engagement of NGOs. And then we have the recommendation 8 and interpretive note. The challenge with this, again, it's that it has this wording of reasonable measures, that NPOs should have reasonable measures to document the identity of their significant donors. But then reasonable measures, we ask ourselves, what are those reasonable measures? It's not really clear on what the reasonable measures mean. And then because there are various NGOs that really deal with confidential or sensitive issues, they may have a challenge of revealing their beneficiaries or revealing issues related to sensitive issues that they deal with, like reproductive rights, rights of sex workers, LGBT. So the wording of also that interpretive recommendation is also a challenge. So the previous speakers have mentioned the process of FATF, the lawmaking process, in a way, by saying that it's exclusionary, it mostly benefits those from the developed countries and not those from the developing countries. So I'll just focus on the coalition, global coalition, NPO coalition, to just highlight that also its engagement in terms of civil society from the South, it's limited. It does not address the concerns of those civil society from the South. Hence, we have seen the impact of these money laundering standards on women and governmental organizations. The impact has been seen through the limit of women rights organization access to foreign funding, foreign donors funding more of international organizations, more than women activists, because they're afraid of what their governments will say or how they'll be treated if they fund these women activists who operate in sensitive areas. So those are the other challenges. And the implementation of United Nations Security Council Resolution 1325 has been affected. This is also another problem of it. And then the de-risking has also affected issues of financial inclusion. So there are various cases of how the FATF recommendation has affected women NGOs in various countries that I've highlighted, like India, the Foreign Contribution Act, the National Policy in Sierra Leone, that has also, the NGO policy, in Sierra Leone, that has also had an impact on civil society in terms of allowing them to operate.
Ms. Butale, I would have loved for you to continue, but we are way out of time.
Okay, I'm just concluding, then I'm done. So
okay.
in the way in which the money laundering and counterterrorism laws have been designed and implemented, we can see that they really have taken little or no account of how women rights organizations operate. And it's important that women organizations should be engaged in the implementation of Recommendation 8. They should be part of the processes so that things are more transparent, accountable, and the objectives are reached. The desired. Thank you very much for your time. Hello.
Okay, thank you very much, Ms. Butale, for your presentation. And we are already out of time, but definitely we have to be fair to every panelist to be able to present the paper. And I'll seriously appeal to the organizers to kindly just give us some additional time. I know we're already out of time, but I wanted everybody to be able to speak to their paper in a manner that they will communicate what they have in mind. I will invite Dr. Chijioke Ofoji now of the Liverpool John Moores University. He'll be speaking to us on the topic, the new CBN anti-money laundering. Dr. Chijioke Ofoji.
Thank you. Thank you very much. Really, I recognize that our colleagues have spoken powerfully about the FATF and the structural issues with AML regulation in the Global South. My own presentation will just try to look at the use of enforcement on the enforcement side. And I'm just going to look at the Central Bank of Nigeria's use of administrative sanctions in combating money laundering and CTF. I mean, in particular in the Nigerian banking sector. This is very much a work in progress. I think my email address is right at the start of the slide there, so feel free to send feedback and thoughts. Can we go to the next slide, please? Thank you. So basically, I'm just going to look at the role of the CBN as a primary money laundering supervisor. But also, I think it's increasing use of administrative sanctions. And we're just going to ask a few questions about where does this leave us and where does this lead us to? Can we go to the next slide? Thank you. I don't want to relitigate much of what has been said in the past about the Nigerian AML regulatory structure, but a number of legislative instruments here that speak to the regulation of money laundering in the Nigerian space. Can we go to the next slide? Thank you. Yes, but the CBN is right at the heart of the Nigerian regulatory tapestry, supervisory tapestry, if you like. It's the key and primary supervisor for banks and a number of financial services providers in the country. And the CBN's powers in this regard is provided by complex patchwork of legislative instruments. One example is the Banks and Other Financial Institutions Act, BOFIA 2020, which recognizes the CBN's role as primary supervisor for AML within the Nigerian banking and financial space, but also empowers the regulator to make policies and issue guidance related to AML and CTF. Can we go to the next slide, please? Thank you. So this slide looks principally at the number of sort of financial actors supervised by the CBN. We've got deposit money banks, of course. We've got microfinance banks, primary mortgage banks, payment, what the CBN now calls payment services banks, essentially another name for payment services providers that also provide things like cards and so on and so forth. And so we also got bureau de change operators and some other financial companies. And increasingly, there is now a view that the CBN is also encroaching on the fintech space as well. Can we go to the next slide? And so I think, the structure, the microstructure of the Nigerian financial space really perhaps makes us recognize, the increasing importance of the CBN. And I think that importance is highlighted by the fact that in 2018, the central bank issued a set of regulations, one of which was the administrative sanctions regulations of 2018. Now, these sanctions were introduced to ensure Nigeria's compliance with Recommendation 35 of the Financial Action Task Force, which indicates the need for effective, proportionate, and dissuasive sanctions in combating AML. And really, I think the need for this, for Nigeria to comply with Recommendation 35 was highlighted in the GIABA 2007 Mutual Evaluation Report, which essentially called the Nigerian authorities to strengthen the sanctions regime against money laundering. Can we go to the next slide, please? Thank you. And in considering this regime, it's important to recognize that it has almost an exclusive focus on monetary fines. Essentially, if you breach certain money laundering requirements on your bank or a financial institution, you could be fined. I should stress as well that CBN guidance does suggest that there are other sanctions, such as the revocation of banking license. Looking at the regime closely, there are 48 possible infractions. I'm not going to go through all of them because I recognize that we are pressed for time here. But it's important to recognize that this is, of course, part of what is now a very evolving and some might say slightly strident, compliance environment for banks in Nigeria. Important as well to note that these sanctions can be imposed by the CBN after an examination of the relevant financial institution or at the recommendation of relevant agencies. Next slide. Thank you. So how are sanctions determined? Well, the CBN will, of course, look at a number of factors, one of which is the nature and seriousness of the breach, the duration and the frequency of the breach, whether benefits were gained or losses avoided as a result of the breach, also the conduct of the financial institution itself and persons concerned in its leadership team. It's also important to know that the CBN will also consider the previous record of the financial institution and whether there are ongoing regulatory enforcement activities against it as well. The next slide. So a few examples. I'm not going to go through all three because we're pressed for time. I'm just going to stick to one, which is failure to render suspicious transaction reports to the Nigerian Financial Intelligence Unit. Here, the executive compliance chief of the bank could cop a fine of 2.5 million naira, which is, some might say, is quite weighty in the Nigerian context. But also they say, so not just the chief executive, the chief compliance officer, the bank itself could also cop a 20 million naira fine. And some might say that this is deeply, deeply weighty. I should stress that these are minimum fines. So of course, the CBN could increase it dependent on the nature of the breach. Can we go to the next slide? So I'm just going to try to evaluate what this regime is principally all about. Well, it's obviously a very key and important addition to, as I said, a complex and evolving regulatory environment for Nigerian banks. There is also, and this is, an important point, a clear focus on what I call the double-edged sword of enterprise-level responsibility and, crucially, individual accountability. So not just the enterprise, the fines are not just targeted at the particular financial institution, but also at a key members of its leadership team. I would also argue that the administrative sanctions regime is, of course, a very, very important tool for corporate governance improvement, not least because it focuses on things like board responsibility, risk management, training, internal control, compliance, monitoring of suspicious activity. There's also, I think, very, very important signs of some form of regulatory flexibility in the sense that sanctions are usually graduated on the size of the relevant financial institution. Can we go to the next slide? Thank you. Since its launch in April 2018, the CBN has seemingly applied, the regime to a number of banks. I think reports suggest that the regime has been using at least 6 to 10 times. It's not entirely clear, and I should stress that this is quite tentative, not least because the CBN has this really, I would say, unfortunate practice of not really publishing enough information about, its use of the fines. And sadly, many of us who are researching this space have to go to the pages of newspapers and also look at the financial statements of the organizations. There are also questions, and this, of course, does raise fundamental questions of transparency. And I think that this is one of the challenges of the regime as a whole. Can we go to the next slide? There are a number of challenges and issues that I highlight. One of them is the transparency of the administrative sanction regime. It's not the use of it by the CBN is not entirely clear. Fines are not published are not very often published on the pages of the regulator itself. One has to dig through the pages of newspapers to find out. Also important to recognize that the increasing use of administrative sanctions does add to this age-long debate and conversation, frankly, about the CBN's quasi-judicial powers. I note that Fola Adiem has written a powerful 2017 piece about this and about the need for stronger accountability structures. I think it's also the risk of what I call over-enforcement, and this might call for a risk-based, or what John Braithwaite will describe as a responsive supervisory style. There's also the probable risk that fines are then internalized by the banks as a cost of doing business, and then ultimately passed on to the clients of the banks. So I think that this is certainly something that we need to watch out for. There are also, in my view, the problem of newer actors on the scene, payment and remittance services providers. These are typically smaller firms. You've got to try to have a responsive approach, maybe to see whether, in fact, the infraction does generate a sizable amount of risk. And if it doesn't, then maybe fines might not be the appropriate tool. It might be best, to consider a wider set of tools. I think that there's also a case.
Possible to wrap up in 2 minutes, please?
Yes. There's also a case for a remediation approach. It's vital that we do not just stick to the stick, but we also have a carrot approach as well, to make sure that we're not just clamping down on banks, but you provide a pathway for them to sort out the internal control issues in the first place. I think this really brings me to the end of the presentation. Thank you very much to the organizers for the opportunity. Thank you.
Thank you very much, Dr. Chijioke Ofoji, and very grateful to our formidable panelists who have been able to present their papers to the audience. And in the interest of time, we are not going to take the question and answer session now. Rather, we try to do that at the end of the next section, which is the session 6. But before I wrap this up, and then probably come back for the question and answer session if we have that time, I just wanted to take this time out to thank the panelists, Professor Abdullahi Shehu, Dr. Constance Gikoyo, Dr. Nkechi Azinge, Dr. Miss Cheludo Butale, and indeed, Dr. Chijioke Ofoji. Thank you for your time.